Welcome back to Fast Market. I'm Tom White, joined by Kevin Hincks, and also we brought back Scott Bauer, CEO of Prosper Trading Academy, to join us. Guys, let's do a quick market check before we take a look at Nike.
E-minis 1%, NASDAQ 1.5%, Dow 1 1/3, Russell 1.5%.
VIX at
to the green side.
Yeah, there's something green. It's called VIX, and it's at session highs above 27. We haven't seen that level for a while, and FANG Plus names taking a beating, down 3.6%, helping lead losses in the NASDAQ, which is down 1.5%, like Kevin said. All right, guys, let's take a look at Nike, because I think there's a couple strategies that we wanted to take a look at. Got some elevated volatility going into this report tomorrow. Scott, expected move priced in the option market of about $4.40 in this name.
Yep.
What do you do in this type of environment with the elevated volatility, and then you got earnings on a name that, you know, moves on earnings,
sure,
but then you've got that additional uncertainty of volatility expanding. We saw it in FedEx earlier this week where it moved more than 2 standard deviations. Your take on Nike?
So I don't think Nike is any different than anything else you look at. I mean, the expected move, the standard deviation is what it is. That's priced into the options. That's why the premium is so high. Volatility is so high right now. So if you believe in what that move is, and that's all a mathematical calculation. I know earlier, Kevin, you were talking about Myron Scholes, right?
Right.
It's all a mathematical calculation. I think the first look at it has to be towards the sell side of premium. That being said, in this marketplace, anything you do, as always, has to be risk defined.
Yep, and Scott makes a great point here, Kevin. One of those pillars that we talk about, especially going into earnings, IV percentile ranks at 100%, so at 52-week highs as far as implied volatility, which you would expect going into earnings and the elevated volatility in the overall market. But what do you, Kevin's going to go ahead and bring that implied volatility up
just to
here
see,
on the chart, Rob.
Then whenever it hits 100, I want to go back 3 years and see.
Yeah.
And look at, that's a 3-year high on implied vol.
Yep.
So it's not 100 for 52 weeks, it's 100 for 156 weeks.
Yep. Yeah, and you make a good point there. So with Scott's notion in mind, Kevin, as far as trying to sell some premium or sell that volatility that's elevated based on your assumption, what are you looking at here as an example type position?
Well, I'll tell you what, this is one of those where if you look at Nike, we've got, what I've got picked out here is the unbalanced put butterfly, 65, 63, 61. So it's only $2 wide.
Okay.
Right? So that's for $1.16 credit.
Okay.
So if we throw that on the Analyze tab.
And you're buying that unbalanced put butterfly. We got another position there we got to delete. You're buying that put butterfly, but you're taking in a credit, and that's the bonus part of this type of strategy.
Now, this is one strategy you could do if your goal was to have a chance to make money on either side, right? With all the other fundamentals in line. The downside, the trade-off of this spread is, on the downside, if you do get a catastrophic move through the break-even part of the spread, which is all the way down to $62 and change, all the way down to about here is where this would move. And if you could see the 1-year chart, that's some pretty significant breakdown.
Yep, and we saw from the chart that Ken had up on Nike that it's at the bottom end of a channel. Scott, Scott, your take on Nike, and it's about $1. That break-even point's about $1 below the expected market maker move. So you're
so it gives you another 25% move or cushion in the stock to the downside. I like the credit you're getting there. I like that a lot.
For $2 wide, that's not bad.
For $2 wide,
that's not that bad. The total risk on this, only about $680.
Yeah. That is the key here. So from a reward to risk standpoint, this is actually better off than many of these other positions that we've seen like this. So again, anybody can look at this and say, well, man, we just had FedEx with that 2 standard deviation move. That same thing might happen here. Yes, of course it could. But if you're a trader, if you're looking at something like this, you play the probabilities. You put the probabilities in your favor. Sometimes they work, sometimes they don't. In the long run, I want to keep doing that. This is a good example.
How about a different look if you're looking for something in terms of a move like maybe up to $70? That would be a little over $2, right? If you think Nike has
muted,
a chance to go back to
muted
70,
a bit, right?
And so you could sell the front month, which is $1.30.
$1.30 in premium for that option that's out of the money by about $3.
Right, and then if you did the 70 calendar spread. Remember, total only about 8 or 9 days, so you could do that for about 30 cents.
Show that on the Analyze tab, Kevin, because I want to give our viewers an idea of different types of strategies.
Hold on,
yeah, just go ahead and click that.
There you go. So you can see right there, that's a different look where you have more of a target in line for Nike. That's on the upside. You could also do, a downside.
65 put or the 60 put. If you, it's all based on your assumption. You guys make a good point there. But trying to take advantage of that elevated volatility that we have in the December cycle that expires tomorrow at the close. So you got to remember that really short-term type of trades that we've got.
Could you do both? Yeah, you could.
You could do both.
You just start racking up a lot of commission.
Right, exactly. You always have to be, worried about commissions, but could you combine a downside butterfly with an upside calendar? Remember, the whole package is still a net credit.
Yep. So now expand that, Kevin, and add that unbalanced put butterfly that you had in earlier with it and show the overall risk profile of that. So
there you would see, look at that. Anything basically above that break, let's make sure we probably have a new break even.
Yep.
Because of the new position.
Yeah, because you're taking a 30.
Slightly lower.
A little bit.
Slightly lower.
Pennies. Right.
Yeah.
Yep.
Yeah.
So there you can see, you've got a big area here, both on the upside and the downside where this is net profitable.
Right.
It's because of the credit.
But in essence, this is still a bullish, neutral to bullish type of trade, and if you combined them both. But I also wanted to bring up another one to take advantage of that implied volatility, where you expect maybe one of those moves that's maybe more than one standard deviation, or at least one standard deviation. So Kevin, if you can sell the December 21st weekly, or the monthly series, the 1 day to expiration, go ahead and sell the 63 puts on the downside. So that's about where they're expecting the move to go, down to about 63 bucks. Sell that for 75 cents, and go ahead and sell the 72 call on the upside. You're taking in $1.40 credit. Now go to the December 28th weekly cycle and buy the straddle at the money, the 67.5. Now let's do the 68, Kevin.
Okay.
It'll play it up to the upside just about 20 or 30 cents. So buy the 68. There we go. So what you're doing here is you're buying a double diagonal. You're paying about a $3.80 debit for it. But Kevin's going to put this on the Analyze tab because I just kind of wanted to show our viewers what to expect. And we had one of these last week that we did, Kevin, that worked out pretty well, or earlier this week, I believe in Adobe. But you can see right there from that risk profile, and now it looks really good. You needed to move away from where the current share price is.
That curvature.
Yep, it is that
big time curvature, and you're looking for at least the market maker expected move, and hopefully for a move outside of that in this position.
And Kevin, your take on this type of strategy. Now, the debit's pretty big on this, and that's that works against what we typically like to do. We like to take credits in.
You've got some money invested on this. That's for sure. That if it sits right here, you're going to have a little decision to make on what to do with that. Remember, the front month, the front expiration, the DC expiration will come off real quickly if it stays in this range. But you have to make a decision with this next week.
Yep. And this, the debit that you're taking on about $3.80, 380 bucks is basically what you can potentially lose on this particular trade. It looks really good here, but you got to remember that volatility in that long straddle that you bought in the December 28th weekly cycle is also going to lose value on a daily basis.
You are going to have theta. So now we owe it to our viewers. What do all three look like?
Oh boy.
Hey, because guess what? In reality, this is what some of these positions look like. You've got positions on top of positions on top of positions, and that's what all three of them look like. And here's what I like. $96 a day in theta, at least for the next 2 days.
Even with that straddle that's built in the December 28th weekly cycle.
And only about a $2 debit or so in this whole thing.
Now,
probably $3, right? $3.83 minus about
$3.
Yeah,
$3.
Right.
Now, Scott, if you were to do the opposite, that's completely opposite of what the double diagonal that I brought up would be, you would do what as a neutral? If you thought Nike would stay in this range, if you think, hey, I'm just going to take advantage of that high volatility, take advantage of option premium being high, what type of strategy would you look to do?
The least aggressive strategy would be to sell an iron condor. Okay, selling a downside put spread around what that market maker expected move is. Selling an upside call spread around what that move is. So, somewhere around the 63 and 72, short strikes. Do that. Or you could do exactly what you did here, flip-flop it, sell the straddle, and buy the wings, and collect that credit in the middle.
Yep, and that's a good point where you're selling the straddle, but then you've got the wings to protect it, still making it risk defined, I think, which is key. Kevin, your take.
The genesis of any trade should be some type of an opinion, right? Let the opinion and the implied vows designate what you do.
Yep,
Dictate what you
and
do.
I think that theme that Scott hit on earlier about being risk defined, especially into earnings, and the market moves that we've seen recently, allows you to sleep at night a little bit. Make sure that you're defining that risk.
Hey, I always tell everybody, and I tell my students, this is how I traded on the floor. I want to be the best bunter on the team.
Yeah. Yep.
Right? I want to consistently bunt. Occasionally you'll get that double or triple.
Yeah.
Limits the strikeouts.
Yep. There you go. Scott. That's great. That is. Yeah, he was a psychologist earlier. He's a philosopher now.
How about that?
All right, Scott, thanks for joining us. And Kevin, as always, that does it for Fast Market. Tune in tomorrow at 10 a.m. Central Time right here on the TD Ameritrade Network.